Most people think investing is complicated. They believe you need high intelligence, insider knowledge, perfect timing. But the truth is simpler and more uncomfortable. People don't fail at investing because they're stupid. They fail because they behave badly. In The Only Investment Guide You'll Ever Need, Andrew Tobias breaks one big myth. Investing is not about being clever. It's about being disciplined. This book isn't written for Wall Street professionals. It's written for normal people who want financial security, fewer mistakes, long-term peace. Instead of hype, this book teaches how money really behaves over time and how you should behave with it. Lesson 1. You don't need to be a genius to invest. Well, one of the most important ideas in the book is this. Intelligence is overrated in investing. Highly intelligent people often overthink trade too much, chase complex strategies. Average investors who stay patient, keep costs low, avoid emotional decisions often do better. Why? Because investing rewards consistency, not brilliance. The market punishes ego impulsiveness, overconfidence, and rewards simplicity time, discipline. Boring investing usually wins. Core Lesson 2. Spend less than you earn. The rule everything depends on. Before investing, one rule matters more than all others. You must spend less than you earn. No strategy works if expenses are uncontrolled, lifestyle grows with income, debt replaces discipline. The book makes it clear, saving is not optional. Investing is impossible without surplus. Many people look for better investments when the real problem is spending. Wealth doesn't begin in the stock market. It begins with habits. Lesson 3. Inflation is the silent wealth killer. Many people think, at least my money is safe in cash, but inflation quietly destroys purchasing power. Money sitting idle loses value every year, shrinks without notice. This means not investing is still a risk. Playing too safe can be dangerous. The book explains that investing is not about chasing returns. It's about protecting your future self. Doing nothing is a decision, and often a bad one. Lesson 4. Diversification protects you from being wrong. Nobody knows the future, not analysts, not experts, not professionals. That's why diversification exists. Diversification means not betting everything on one asset, accepting uncertainty, reducing the impact of mistakes. People lose money when they go all in on one idea, fall in love with one stock, believe one prediction. The smart investor assumes, I will be wrong sometimes, and builds protection around that fact. Diversification is humility in action. Lesson 5. The stock market rewards patience, not timing. Many investors try to buy at the bottom, sell at the top. Most fail. The book explains that timing the market is nearly impossible. Missing a few good days can destroy returns. Long-term success comes from staying invested, ignoring short-term noise, letting compounding work. Markets move emotionally in the short run, but logically in the long run. Time in the market beats timing the market. Lesson 6. Fees matter more than you think. Small fees feel harmless, but over decades they drain returns, reduce compounding, transfer wealth quietly. High fees don't guarantee better performance. Often, simple, low-cost options outperform complexity benefits providers, not investors. Every dollar paid in fees is a dollar that can't compound. What you keep matters more than what you earn. Lesson 7. Don't confuse entertainment with investing. The financial world is full of news predictions, hot tips. Most of it is entertainment. The book warns, constant news creates anxiety. Predictions encourage overtrading. Activity feels productive, but isn't. Real investing is boring. If it feels exciting, you're probably taking unnecessary risk. Calm money grows. Emotional money disappears. Lesson 8. Debt can destroy or support wealth. Not all debt is equal. The book explains high-interest consumer debt is dangerous. It works against compounding. Debt increases pressure. Pressure leads to bad decisions. Some debt may be useful if controlled, affordable, strategic. But most people underestimate how debt limits freedom. Debt reduces options. Options create wealth. Lesson 9. You will make mistakes. Plan for them. Mistakes are inevitable. The difference between successful and unsuccessful investors: one survives mistakes, the other is destroyed by them. Planning for mistakes means emergency savings, margin of safety, flexibility. People fail not because they're wrong, but because they can't afford to be wrong. Room for error is power. Lesson 10. Taxes matter, but simplicity wins. Taxes affect returns, but obsessing over tax tricks can increase complexity, encourage bad investments. The book suggests understanding basics, avoiding unnecessary tax losses, prioritizing long-term growth, good investing balances, efficiency, simplicity, peace of mind. Complexity often creates stress, not wealth. Lesson 11. The market doesn't care about your feelings. Markets don't reward hope, don't punish fear, don't respond to effort. They respond to time, discipline, behavior. Panic selling locks in losses. Greed locks in mistakes. Successful investors learn to do less, react less, trust long-term logic. Emotional control is a financial skill. Lesson 12. Investing should help you sleep at night. If your strategy causes constant stress, makes you check prices daily, creates fear, it's not sustainable. The best investment plan is one you can stick with, understand. Live with reasonable plans. Outperform perfect plans that are abandoned. Peace of mind is an underrated return. Core Lesson 13. Wealth is built quietly and slowly. Most people want fast results, big wins, visible success. The book reminds us real wealth grows quietly. Slow progress compounds, patience beats excitement. By the time wealth is obvious, the work was done long ago. The biggest truth of the book: investing success is not about prediction, intelligence, complexity. It's about spending less than you earn, staying invested, keeping costs low, controlling emotions. Most people don't fail because they choose the wrong investments. They fail because they abandon good ones at the wrong time. If you want to build wealth without stress, hype, or confusion, subscribe to Money Talks. Because investing isn't about being smart. It's about being consistent.